This is Scott Becker with the Becker Private Equity and Business Podcast. Each day we try and come to you with short business and private equity episodes, as well as discussions with brilliant private equity leaders. We're joined today by one of those and one of our most listened to guests. We're joined today by Matt Wolf of RSM. Matt, I think you guys just released your 2025 forecast report. What should we expect for next year? What's on the horizon?
Yeah, thanks, Scott. Happy to discuss. So at a high level, our baseline expectation for GDP growth next year is 2.5%, which is fairly robust compared to the 1.8% that we saw for most of the years after the global financial crisis. That was kind of the average up until the pandemic. Still expecting full unemployment rate around 4.2%, strong productivity gains and investment, and a Fed funds rate of 3.5% with a 10-year treasury at 4.5%. That's sort of our kind of base case, really built, along all these sort of typical economic assumptions, but additionally specific to the incoming administration, assuming that, the trade tariffs are a little more muted, at least in 2025. We don't expect, it doesn't seem legally possible to kind of put together 60% tariffs on China, 10% everywhere else day one. That will take time to run through the legislative process, as would any sort of like immigration reform. So essentially, some changes due to the incoming administration in 2025, but we're expecting some of those bigger headline changes around tariffs and immigration policy reforms to take some time to really affect the economy, whether positive or negative. So 2025, again, 2.5% GDP growth, full employment, 4.5% 10-year yield, with a Fed funds rate of 3.5%. We do expect, as do many others, that the rate at which the Fed cuts rates will decline next year. We could see, maybe even 125 basis point cut a quarter going forward as the Fed anticipates some of these policy changes.
Thank you. And Matt, any thoughts on this? The deficit, is the deficit going to keep expanding, or will it come under control just a little bit just because some of the costs of the ARP will start to roll off? What's your sense of where we're at on deficit? Because this seems like a looming debacle, and at some point is an overlay for everything. Any thoughts or discussions there in your guys' report?
Yeah, we do expect at least key provisions of the 2017 Tax Cuts and Jobs Act to be extended, and that will likely add to the deficit. It's difficult to see how those could get paid for without touching entitlement programs that we suspect are, neither party really would want to touch, especially not to pay for the tax cuts. So, who knows exactly how it will go forward. But yes, I think extending the tax cuts, we generally expect it will add to the deficit.
Thank you. And what about the private equity business environment, deal environment? What do you see there? What's your take on the lending environment into it? Interest rates are going to come down a little bit, but doesn't seem like they're going to speed down. Any thoughts on what you expect in terms of the private equity deal environment?
Yeah, I think probably pretty unsurprising that, the lower interest rates will be positive for deal making, and the incoming administration will likely result in some, favorable looks on regulations in terms of deal making, right? All else equal, would expect less oversight from government agencies into, certainly large deals. Now, there are some, as I understand it, I'm not an attorney. Maybe you can educate us more on this, Scott. But changes to the Hart-Scott-Rodino Acts or pre-merger notification rulings that are taking effect on January 1, that may drag on some deal making. There's probably other pockets specific to certain industries, but in general, we expect the incoming administration and the lowering interest rate environment to be positive for private equity deal making across the board.
Right. Certainly, this era at the FTC is coming to an end, which has been a very aggressive era. not necessarily bad nor good, but certainly very interesting to see the aggressiveness of the Lina Khan administration. Is there discussion yet about who President Trump will choose to run the FTC after Lina Khan?
I haven't seen anything credible, which is kind of surprising. I had expected it to be maybe one of the earlier picks or announcements, since it was a fairly focal point of some of the stump speeches and the campaigning. But yeah, I also wouldn't have guessed Dr. Oz to run CMS. So until I see something in paper, I'm probably not going to speculate too much. I don't have a great sense of who it could be.
No, I think that's a good call. I think it's fascinating because I mean, there's obviously some picks that I love of his, at least Stefanik, some others. There's others that you look at sort of with a little bit of shock and awe and excitement, like Dr. Oz is sort of this Medicare Advantage privateer who that seems like a horrendous program, but it seems like it's going to get more legs under Dr. Oz in charge of CMS, which is insane. One of the things that I've seen some great health systems double hat people. So you'll see them have a CFO, also sort of a COO for a period of time, or run two hospitals. We've seen some of that over the course of our career, where you have a really talented person. Stanford used to do it with a leader called Dan Morissetti, who ran a couple big roles at Stanford Health. But I take it there's very little chance that Matt Gaetz will get the chance to be both Attorney General and run the FTC. I think that's probably out of the question, wouldn't you think?
Yeah, I think that's probably a safe bet. Yeah, interesting idea, but yeah, that's a good point.
It's unlikely to see Matt Gaetz double hat. Correct. In any event, Matt, I know I can't take you too far to this discussion because you're at a mega firm that gets mad if we talk too much about these things. So I will move on to the discussion very quickly. Any other thoughts for next year in terms of, you're at one of the best firms in the world, RSM, and RSM does not want its people talking politics. So I'll do the talking and you just, react to my ridiculousness. Tell us, Matt, what you see sort of, what else are you guys seeing for next year? I mean, a sort of the HSR stuff could cause some ripples or challenges in the deal environment, but other trends in the right direction. Private equity still has a ton of money to put to work. Still a ton of private debt, private lending out there. Anything else you're watching?
Well, yeah, I would say the inventory buildup across retailers, right there, retailers and manufacturers buying inventory in advance of any sort of expected tariffs that we don't totally know the scheme and scope of yet. We know what's been promised. We don't know how that's going to play out. And, we could find ourselves in a situation similar to as we unwound from the pandemic era restrictions and the supply chain issues caused there, right? Where retailers, manufacturers overbuy inventory to get ahead of potential pandemics. And we saw some of that with earnings releases even already for different reasons, but still overbuying of inventory. That could lead to aggressive discounting. That could lead to difficult profit margins in sectors. It could even potentially affect consumer buying power, that there are layoffs and things. There's a lot of sort of tendrils throughout particularly the real economy, sort of middle market real economy when it comes to these inventory levels. So that is something that we're watching just to kind of gauge what sort of effects that might have, not only on GDP growth and sort of the top line macroeconomic effects, but just on sort of typical business operations and deal flow as well.
No, thank you very, very much. And I find the thing about inventory to be fascinating. For a period of time, Lululemon, which was one of my favorites at one time, at least for sweatpants, its stock is down 40% this year. At one point, they had these great sale racks where you could find sort of inventory you still liked, like sweats that were, last year's sweats that would cost $118, $120 retail, but you could get them for almost half that price on the sale rack. And for a couple of years, it's just been total garbage on that sale racks. But I do see some of this buildup of inventory you're talking about even before the tariffs, because, all of a sudden you've got sale racks there that are almost useful again. Almost, stuff you could buy again. So we'll see how that goes in terms of the buildup of inventory. It'll be fast to see if that happens. I think people are so scared to build up inventory, but also don't want these empty stores they had during the COVID pandemic. And I hope that we don't get to 60% tariffs. I don't think we can handle that. But some tariffs to make good on his campaign promises. God bless. Matt, Thank you, as always, for joining us on the Becker Private Equity and Business Podcast. What a pleasure always to visit with you. Thank you very, very much.
Thank you, Scott.